hello. Let's talk about the trade that we're going to be putting on, that we've already had on, and then we're going to add to this position. Um, the general idea, the general play, is that yesterday we held off on putting on this trade. Essentially, we lagged into it, initiated the position because we feared that Trump might end the war essentially yesterday or announce the complete withdrawal from the Middle East. But right now it is quite clear the intentions and that it's never going to happen unless they are completely defeated there. The problem right now is they cannot withdraw completely because it's the end of the post-war World War system. World system, currency system, reserve asset system. It's the end of the dollar, essentially. Actually, it is like the fall of the empire and the end of the petrodollar system, where commodities no longer are being priced in dollar. That means that the premium from the currency, from the dollar, is going to go out significantly, pretty significantly. It's going to be a massive devaluation of the currency, forced devaluation, because they don't have any other choice. It's either inflate away or face an economic catastrophe on a scale of 1929 and so on and so forth. And they're not leaving, but the funny thing, they can't do anything about this as well. And Strait of Hormuz is going to be closed for another week, definitely week, 2, 3 weeks, I don't know. And it's pretty clear that we're going to get into the demand destruction at this point. The trade is the same trade that we've been seeing, and Dixie higher. Dixie built and created a trend higher low, overextended on the upside, bounced into the cycle high, massively retraced into those news, by the way, into quarter end. Yesterday was the first day of the new quarter, right? That's why we've had this massive spike in SPY, completely unwarranted from the fundamental perspective, obviously, right? Nothing has changed, essentially. We opened the week right here, and other than this is just flows. Everything works a certain way, and this is how market flows, ebbs and flows. So you gotta understand how this thing works. Dixie, this trade is still intact. Once again, Dixie higher, oil higher, inflation higher, long end yields higher all over the world, and SPY lower, risk lower. And this is going to persist and accelerate coming into the next weeks, because we're entering actually the first stage of the real problematic stuff with oil. We might see an actual oil spike now. They kind of averted. And oh god damn, I didn't see that. I saw just a +5. This is going to continue. We're gonna see 130 and 150 and so on and so forth if this is not resolved and Hormuz is not opened for, right now, essentially. So and you look at the US 10-year and you look at the US 30-year. The complacency is unbelievable. Next week, we are getting inflation report, and is gonna blow the fuck out. Every single time, if we are viewing this year and this current move from the lens of 2022, right? Inflation shock, and they are hiking rates and everything else, repricing relative to rates. If you look at the US 30-year, you look at these ebbs and flows, they came right in 2022. You look at the SPY and SPX and how it traded in 2022. You can, I don't have it on the chart, but all of these major highs, lows, highs, these tops, after which followed a massive repricing lower, came on the back of, once again, here is an inflation report coming, here is a FOMC coming, and then massive move lower. Inflation report, move lower. Inflation report, move lower. Inflation report, move. You get what I'm saying. And we are getting that inflation report that's going to be reflecting those realities already. And inflation after that is going to come in even worse. And there is no end in sight. And what we have now is we have this. Save, open, print. What about print? Can I do that? No, I can't. Okay, let's just copy, let's just save. It's going to be easier. Save this desktop. This is the implied volatility on TLT, and you can see the clear low end here, and this is 6 month implied volatility. And if you look with 1 year, 2 year implied volatility, we are at the lowest points right now comparative to compared to reality on the ground. Same thing with SPY. Shorting SPY into that bounce made a lot of sense. This is your quarterly open, repricing, reevaluating things, plus SPX collar, plus the fact that we had this on Wednesday for yesterday's market expectation that something's going to be good, something's going to be resolved, which is obviously not, and gamma is negative, and you get these types of moves. It's completely natural. I would be adding shorts on this big time. So US 30 year, we want to go long US 30 year and short TLT big time, and our time frame is on Friday, next Friday. This Friday is going to be, we're going to get, what is it, some holiday, so it's going to be a long holiday. We're going into the long holiday. Some escalation is likely during this long holiday. Oil continues to spike, and next Friday we're going to get inflation report, and I would not be surprised to see TLT reprice lower down to 83 over the next 2-3 weeks essentially. So that's what we are playing for, and the simplest thing is just to go long puts essentially, because unlike SPY, we don't have volatility compression in TLT. We have a clear low end, and which will blow out if that scenario plays out, and I don't understand how it can possibly not play out. Now, SPY is quite clear. This is a short, and we're going to be adding to this. We're going to explain how we're going to be putting this position on. Oil is blowing out and will continue to blow out if this all remains. Yeah, it's just, you can see the disproportionality and disproportional move. Oil is moving like that, and SPY is not falling like 3%. It's, well, we understand why that's happening. Let's just go quickly over the entirety of the signal. Bitcoin negative trend, negative trade. Remember, we flagged that Bitcoin is going to be turned into positive trend here, and we're going to get Bitcoin is going to be resilient, but this is not a long, and it has been resilient through all of this, and then here, there we go, we break trend, and now everything shifts back, and now negative trend, negative trade. Once again, Bitcoin 60, sub 60, 55, 50,000 is coming. This is supportive of that type of position that we're trying to put on. Signal in Dixie is supportive of the type of position we're trying to put on. Everything in currencies are pointing to in the same general direction. Oil, obviously, well, holy mother of Jesus, the inflation report is going to be fucking disgusting. I mean, I have no. I mean, okay, we shall see. Oil is nice. Continues to move higher. Demand destruction. The faster it goes higher, and if it continues to 130, 140, 150 at accelerating pace, I honestly don't even know if TLT position is going to work. I think it's going to work because we're going to get the initial impulse lower, definitely, meaning initial impulse higher in yields, and they're going to come in and print money. They're going to cap yields. There is literally no other way around this. They can let yields reprice like for the 10-year to 5.5, but I don't know. We shall see how it's going to play out. This is exactly the same trade, supportive of that. Gold is not going anywhere. Once again, gold is going to be in a consolidation period for a while. I would expect us to revisit even 4,000 on a massive dip and maybe a capitulation if that comes. We shall see. We need to understand the reaction function of the Federal Reserve to all of this, all of these dynamics, but this is all a buy. Essentially, how I'm looking at is, however, at some point during this year, whatever happens, if we go below this low, this is a unbelievably massive buy from here, regardless of what it does here. This is, you buy here regardless of implied volatility, regardless of anything you buy. Other than that, you just wait. You wait here. Whatever it does here is going to be on a high volatility, massive move, high, lower and higher. We're going to wait for the signal to shift into positive trend, and then we're going to put on the positions 2 years out. We are essentially, what we are playing for is, we are seeing this as the Same thing that happened in 2008 and 1970s. Massive move higher, secular move higher in gold. Then some period of catastrophe, period of big problems. This lasted for less than a year, 2032 something days, and the last stage of the repricing, here it happened like at 170. This time is going to be much larger move. In 1971, the same thing. 1974 from 76, this lasted for much longer. Massive move higher, than a consolidation and gold price, and then a blow off top again. And you can see that everything in finance happens much faster, for the simple reason that the reaction function of the Federal Reserve is much faster. They're like trained dogs. They're not gonna wait like in 2000. It took 2 years. This time it took less than a year. This time in 2008 it took less than a year. This time it's gonna take a couple of months, if even a couple of months. So they waited here until SPX fell like 50+%, and then only then they intervened, and then we received the same thing. This time it's going to happen much faster. They will be forced to do that. They don't have any other choice. So here, this is the biggest play essentially of the coming years. It's the cleanest expression of everything that's going on right now in the world. I'm going to be waiting for this. And I'm going to be looking to put on like 2 years out call spreads. We're going to be laddering this. So how we look at this is, as soon as the signal triggers, let's say it's going to happen closer to the end of this year, maybe even earlier. What we're going to be looking, and let's say we're trading essentially signal triggers at this prices that we are right now. We are looking to put 2 years out, and our base case that in 2 years time we're going to get a 60+% move higher. This is a base case. So what we're going to do is we're going to put like something, let's say from these prices. We're going to put 500, 550 call spreads, 2 years out, all the same expiration. And it is 26%, expecting a 26% move higher. And that is going to give you not a big risk reward. That's going to give you like 1 to 3 risk reward. And you're going to put $3,000 into this. So you're going to be making $9,000. Then you take those $9,000 and you're putting 550, 600 risk reward, 600 call spreads. That's 36% higher. And you put $5,000 into that. And then you take, essentially you are financing these deep out of the money call spreads with slight out of the money call spreads. So if gold does rise like 38%, which is very conservative, I don't think it's going to happen. I think gold rises 60% minimum. And by the way, these like 600, 700 call spreads give you like 1 to 10. And I really think that we're going to overshoot on the upside. It's all a matter of time. We're gonna get a blow off top, and gold is from these prices. The end of the cycle is gonna be 100+% away from us, maybe even 200% away from us. Yeah, even more than that. So what I'm gonna be looking at is putting like something. Main position is going to be in between this base case, right? 650, 700. So actually looking for that 60% average move. But then I'm going to go and I'm going to put on like the remaining of the money that I want to dedicate to this into something like expecting an 80% repricing higher, meaning putting on like 750, 800. Those are going to be giving you, 1 to 20 risk reward. So that's what we're going to be looking at. Okay, this is the gold. Generally, a US 2-year yield. It's irrelevant. I don't think this is what you should be trading. They're not going to be raising rates into this. They cannot be doing this. Essentially, they just can't be. They won't, and they can't. Markets ignored the fact that they're not going to raise rates, but we're still going to be pricing in the expectation of them raising rates for the simple reason that inflation is going to spike so much, and inflation is on the April 10th. And the Fed meeting on April 28th. So, and the market is going to price in cuts. Yet, when 28 comes, they're going to disappoint market in terms of cuts. They're going to be dovish. They're going to be, oh wait, this is transitory, this leads to nothing, and that will lead to this moving even higher. And what happened with the 30-year yields? We've just created a trending high low. This is textbook. This is beautiful. You have initial move higher on the initial shock. This is your first leg up in the instrument. Then you have, if the instrument is very strong, meaning the trend is very strong, after you break trend resistance and tail resistance, which this is your high, this is your tail resistance, we smash through this, you absolutely expect some sort of consolidation, at least in time and space, and then retracement. And first break in trade after shift into positive trend, you always buy. But this time, we didn't even break trade. We just ran it, created trend high-low. This speaks to the strength of the trend. So your position essentially is this. We've entered this yesterday, even lower. We entered this very close to the trade itself, so the position is somewhat, well, this is, you would think this is your stop, but your stop is it's floating. It's with options essentially, with puts. But now we're going to be adding to this with Alacrity, and this is your same stop, same position, same everything. Expecting repricing to minimum 5.2, and we are mostly playing not the delta move, meaning price move, but volatility. Volatility is very cheap on this. Vol is very cheap. As soon as that inflation print comes out, it's going to be coming out on Friday, and Monday is going to open horrendous. Implied vol is going to blow out, and voila. Essentially, these things are going to work very nicely. This is how I'm foreseeing this. All-time highs, definitely. This is your move. This is your, once again, we had the end of the quarter. Quarterly end was 2 days ago, and this quarter is going to be expansionary. We're going to see this happening. We're going to see this happening this quarter. New month, new quarter, and very, very conducive for expansion higher. Very conducive for expansion higher. So we're going to be adding to this, shorting this, and GNK once again, high yield is confirming the same thing. We've went on high vol into trade. You always sell this, This is beautiful. This is exactly what's been happening in 2022. This is it's this kind of moment, it's this kind of moment, this kind of moment, it's just beautiful. It's beautiful how things trade. And this move in rates naturally will cause SPX to reprice, and I would expect SPX in 2 weeks time minimum, maximum in 6,200. So what we're going to be doing is we're going to be adding to the same position that we had. It already worked. We already have the same position that we have on. We're going to sell SPY. We're going to be selling 670, 680 call spreads and financing 620, let's say 620, 610 put spreads on SPX. That's what we're going to be doing. These are the two positions, this and long TLT. In these times, you gotta be directional. There is no reason to hedge anything, to do pairs trade or anything. This is the time to be directional. This is I clearly see this window of potential repricing over the next 2 weeks. So yeah, Apple remains Apple. Tesla remains Tesla. We still have puts on Tesla, mainly 340, 330 and 330, 320. Yeah, so that's your general idea. And once again, I would not be expecting a massive repricing in rates. You would see right now what's going to be happening is 2-year yield. This move in gold came on the back of, once again, naturally, after this is when something doubles or triples like gold did, especially with this much implied volatility, it enters the social sphere, and naturally with that right side volatility also comes with a left side volatility. So these are the types of moves that happen before a massive expansion, another massive expansion in implied volatility, and another massive move higher. So what I'm going to be expecting here is, once again, 2-year yield is not going to be moving that much anymore. It's not going to be repricing that much. And they're going to be dovish. They're going to be continuously dovish. So gold is not going to be 10-year and 30-year is going to be printing all-time highs, yet gold is not going to be moving lower lockstep with them. It's going to be the same thing that has been happening. Where is it? In 22, later on. In 2022, we had this clear repricing, and once again in gold, because of clear repricing in rates higher, right? Massive move in rates higher, massive move in rates higher, lower in gold. But then we've had a massive move in rates higher, yet the amplitude, the magnitude of the gold retracement and a down move in gold and the sensitivity of gold price to the interest rates came down significantly. This is what I'm going to be expecting here right now, and we already seeing this. So it doesn't matter how high rates go, gold is going to be less and less from these prices, less and less sensitive to it. It's going to be still is going to be very much in a very defeated state. A lot of things are weighing on it right now, but at some point during this year there's going to be a snap. There's going to be a change in trend, and this is where you want to go unbelievably big in gold. I believe unbelievably big in gold. Okay, so this is the trade. Oil is going, and it does what oil does. This is how it happens essentially. This is natural. This is very natural. We created a trending high low, move higher, new month, future contracts rolled, some sort of hope for a ceasefire, anything, but this situation is such that there is no resolution to this war. Literally, there is no resolution to this war. That's why Strait of Hormuz is not going to be opened. I do not know. There is no feasible resolution. So let's see. We gotta feel the pain first, and only then some extraordinary steps are going to be taken. No one feels the pain yet. Yes, Iranians do, but the West markets are completely fine right now. And this thing is going to be resolved, and not going to be resolved until markets force Trump to do something. Meaning the move is going to be the same, akin to what we've seen in the magnitude of the move. Maybe not the volatility, not the speed of the move, but the magnitude is going to be the same as we saw in COVID and all of these major lows. Yeah, and all of the smart people, all of the smartest people in the oil industry are saying, all of the people that are usually during these types of crises, during the 2022 crisis, invasion of Ukraine, during the this type of debacle, during all of the crises, all of the smartest people that have like 40 years experience in the industry, that always in 2022 they were saying, I mean, it's, guys, relax, it's all fine. We understand that there is a problem, there's a massive shortage, loss of barrels, so on and so forth, but the market is very resilient, is very flexible, it's gonna adjust, we're all gonna be fine, it's okay. It's, yes, pain is gonna be felt, but it's gonna be fine. All of these people are saying, holy fuck, like the worst case, worse than the worst imaginable case scenario is happening right now. All of these people that are very much not alarmist, are incredibly not worried, catastrophically afraid of what's coming. Like, these people are saying that, oh my goodness, if this thing is still closed over the next couple of weeks, first of all, the damage is unbelievably large, even if it's resolved today. If it's still closed, let alone month, couple of weeks, the catastrophe is wow. We're gonna see oil spike. And by the way, look at this. You think this is a big move, but this was the collapse of the Soviet Union, and this is your repricing that happened then. Look at this. First month, big repricing upwards of 30%, close, move higher of 53, close at 30, and then another move from close next month plus 44%. What happened today is like 10 times larger than what happened here. Like 10 times, 20, 30, 50 times worse that happened here, that made the market reprice the 90% in the span of 2 months. We've already had the first month. We already have this move 58% lower, close at 35. From here, from the close, another 40% will be 140. But given the fact that this is so much worse, so obviously, once again, oil theoretically can print 200. Oil theoretically can print 300, but it's never staying there. The governments of the world will not allow oil to stay there. Some extraordinary measures. The demand destruction will be as such that the higher oil goes, the faster and lower the move, the stronger the move lower is going to be. But demand destruction is going to be unbelievable. The pain is going to be unbelievable. And this period, however long it lasts, month, 2, 3, 4, 5, 6, year, 2 years, lasts this demand destruction, this pain, I don't know. But once again, looking at all of this, like 50% would be your best case, 150 oil, but not surprising like 200 oil. Like people are, all of the smartest people saying like 200? Ha! I mean, it's easy. I'm afraid of oil going to 300, 400. Like, goddamn, this is a catastrophe. This is a catastrophe. This is just the beginning, and we shall see how it's gonna play out. I don't know. I don't know. I don't know. We shall see. Yeah. So yeah, what we are going to be doing now is once again playing this through the second order effects. The derivatives of that is this and this. Yeah, that's the general idea here.